The illusion of the silver bullet. This is Alawa Baybar HQ. We are initiating an explainer on the anatomy of an enterprise rollout failure and a multi-million-dollar recovery at Nestle. Software installation is not solution implementation. Automating a broken workflow simply scales inefficiencies at an enterprise level. At first glance, enterprise resource planning systems present themselves as the ultimate corrective measure for deep-rooted organizational friction. Vendors aggressively market these platforms as comprehensive solutions capable of re-engineering business processes, synchronizing geographically dispersed operations, and empowering users with real-time data consolidation. The reality is distinctly less forgiving. These structural overhauls exact a severe toll in terms of financial capital, operational disruption, and human friction. Implementation failures are commonplace, characterized by ruptured timelines and decimated budgets. Yet, the architectural post-mortem of such implementations provides an uncompromising executive blueprint for technological survival. We are going to dismantle the critical phases of the Nestle enterprise rollout. We will strip away the vendor marketing to isolate the precise mechanisms of its near collapse, and heavily examine the strategic triumph of its eventual recovery.
Analytical framework. Our operational roadmap for this explainer is straightforward. We will dissect the high-stakes and executive overview, followed by the vanilla pricing operational chaos. Then we move into a detailed ERP implementation post-mortem, the human element and resistance, the chronological recovery action plan, and finally, the Phase A core stability guardrails. High stakes and executive overview. Section 1 establishes the immense financial and structural scale of the initiative.
Capital commitment and global standardization. Enterprise software transformations of this magnitude are not mere IT upgrades, they are fundamental rewiring operations of the corporate anatomy. To comprehend the gravity of the subsequent failures, one must first respect the vast architectural footprint Nestle attempted to unify. The mandate required the systematic dismantling of entrenched regional economy in favor of a monolithic global standard. Nestle SA committed massive capital to leverage its global size. The objective was standardizing processes across 230,000 employees in 80 countries. In the year 2000, headquarters in Switzerland recognized a critical vulnerability. Despite their massive market presence, they were failing to operate as a singular, cohesive entity. To correct this fragmentation, leadership executed a $200 million contract with SAP. This initial capital expenditure was merely the software foundation. A secondary commitment of $80 million was immediately authorized for consulting, maintenance, and routine upgrades. The executive thesis was direct. Nestle SA required standardized business processes to maintain a commanding competitive posture in the global economy. The architectural scope included financials, accounts payable, accounts receivable, supply chain management, demand planning, and business intelligence modules. This was a total operational override, scheduled initially as a 3-year rollout for the largest global sites.
The decentralized landscape. The initiative was highly decentralized in its early stages. Regional divisions like the UK and USA attempted massive, independent unifications to dismantle their legacy systems. The global strategy was deeply informed by these regional precedents. Nestle UK had already concluded a 5-year implementation across 18 manufacturing sites. They transitioned over 6,000 users to SAP R/3 specifically to tighten their supply chain. Simultaneously, Nestle USA initiated Project BEST in 1997. This stood for Business Excellence through Systems Technology. Nestle USA was an $8.1 billion subsidiary operating as a collection of fiercely independent brands. Budgeted at over $200 million and mapped against a 6-year timeline, Project BEST was designed to unify the American division. The One Nestle Vision. CEO Joe Weller mandated the transformation of highly independent brands into one tightly integrated corporate entity. Legacy fragmentation. Prior to this initiative, the American division operated with an astonishing 9 disparate general ledgers and 28 separate points of customer entry. The strategic imperative. The core objective was to reduce these highly fragmented data structures down to a single authoritative ledger.
The Vanilla Pricing Operational Chaos Section 2 examines the vanilla pricing operational chaos. We must observe the baseline operational reality to understand the necessity of this transformation.
The cost of autonomy. Before evaluating technology, executives must audit their existing workflows. The primary driver for an enterprise system is rarely the allure of new software. It is the urgent need to correct systemic, localized inefficiencies that scale into massive financial hemorrhaging. The reality of Nestle's baseline operations was chaotic. Nestle USA was paying 29 different prices for the exact same vanilla to the identical vendor.
In 1997, a dedicated team auditing the disparate systems across the American subsidiary uncovered this severe redundancy. Every single factory operated with complete autonomy regarding vendor negotiations. Because the factories did not communicate, they could not leverage the collective purchasing power of an $8 billion enterprise. The vendors simply observed this fragmentation and adjusted the price per factory based on localized willingness to pay. This isolated example reveals the hidden tax of decentralized operations. When a unified corporate body fails to centralize its data, it actively subsidizes its own supply chain inefficiencies. Automating this broken workflow without fixing the process would simply scale the inefficiency.
Data silos and corporate blindness. This absurd redundancy was driven by autonomous factory purchasing and disparate coding. It blinded corporate headquarters to actual manufacturing costs. The financial bleed of 29 different price points was compounded by a complete lack of master data governance. Coding discrepancies. Factory A logged the raw material as code 1234, Factory B logged the exact same material as code 7890. The impenetrable fog. This complete lack of nomenclature standardization created an impenetrable fog for the corporate headquarters. Executives were structurally incapable of running cross-plant comparisons. Calculated failure. It was mathematically impossible to calculate true aggregated manufacturing costs because the core data architecture was fractured. This illustrates a fundamental axiom of enterprise architecture. If the underlying data is incoherent, leadership is operating completely blind. Securing baseline core integrity is a mandatory prerequisite before any advanced optimizations can occur.
Detailed ERP Implementation Postmortem. Section 3 is the Detailed ERP Implementation Postmortem. We dissect the precise mechanics of the operational failure.
The executive vacuum. Automating broken workflows only scales inefficiencies. A profound misunderstanding of change management and system architecture nearly derailed the entire initiative. The initial phase of Project BEST serves as a definitive case study in how top-down technical deployments fracture when they ignore the operational realities of the ground floor. When Project BEST commenced, 50 top executives and 10 senior IT professionals were assembled into an isolated task force. Their directive was to invent a universal set of best practices for every function across the entire organization, from manufacturing to sales. This methodology is fundamentally flawed. A technical team concurrently attempted to force a common data structure across the company based on these executive dictates. By the time the rollout initiated in 1999, immense friction was immediately apparent. None of the functional groups directly affected by the new processes were granted a seat at the stakeholder table. Redesigning complex workflows is impossible without consulting the personnel who actively execute those workflows daily. Dictating operational flow in a vacuum guarantees rapid system rejection and destroys any chance of establishing Phase A stability.
Artificial deadlines and structural compromise. The project team compromised structural integrity to beat a calendar date. They fatally overlooked critical integration points between modules. The implementation architecture was severely damaged by an external non-negotiable constraint. Nestle USA was using the ERP rollout to simultaneously solve their Y2K vulnerability. When a project timeline is dictated by a calendar event rather than the completion of business requirements, severe technical debt is accrued instantly. In their rush to deploy before the millennium turnover, the technical team skipped the foundational integration testing required between disparate software modules. They successfully installed individual modules but failed to ensure those modules could exchange critical data. This is the exact moment where the reality of real-world technical debt defies the frictionless promises of vendor marketing.
The breakdown of module integration. The modules failed to communicate, creating severe financial discrepancies. The consequence of rushing the architecture was immediate and highly visible in the financial ledgers. Consider the workflow mapping that occurred. The sales input. A salesperson successfully negotiates a discount with a client and inputs that data into the sales module. The blind ledger. Because the integration points were severed to save time, the accounts receivable module remained entirely blind to this transaction. The financial collision. When the customer remitted payment for the newly agreed-upon discounted amount, the primary ledger flagged the invoice as partially paid. This triggered unwarranted collections protocols and corrupted the revenue data. Clean financial ledgers and data migration are the absolute bedrock of operational survival. This scenario proves conclusively that isolated software functionality is entirely useless if the systemic data flow is broken.
The human element and resistance. Section 4 addresses the human element and resistance. Technology collapses without human alignment.
Morale failure and institutional knowledge drain.
The most sophisticated enterprise architecture is entirely dependent on the willingness of the workforce to adopt it. When leadership ignores the psychological friction of major process re-engineering, the resulting resistance can halt operations entirely. By early 2000, the implementation had mutated into an operational disaster driven by change fatigue. Employees were confronted with a new, highly complex interface paired with entirely new, poorly communicated business processes. Their identity capital, the professional worth tied to their mastery of legacy systems, was wiped out overnight. Divisional executives were equally disoriented, having been excluded from the planning phases, and consequently offered minimal support to their struggling teams. The resulting change fatigue was devastating. The organization began hemorrhaging institutional knowledge. Losing over 77% of the personnel responsible for predicting market demand crippled the supply chain forward visibility. This metric stands as a stark executive warning. User resistance is not an abstract human resources problem. It is a measurable variable that directly degrades operational capacity.
Process precedes platform. The realization dawned that process change and universal buy-in are the true prerequisites for a functional enterprise system. Reflecting on the near failure, executives crystallized their core error. The primary focus of any technological transformation must be securing universal buy-in and mapping the business processes prior to activating the software. Process must always precede platform. An installation is merely a technical deployment of code onto servers. An implementation is the strategic alignment of human capital with new optimized workflows. Attempting to force an organization to adapt to a software package without securing their consensus results in immediate and severe rejection. The system must serve the business process, and the human operators must understand and accept that process to protect their core efficiency.
The imperative of continuous training. Training must be treated as a continuous core component, not a temporary appendix to the rollout. To bridge the gap between a technical installation and a true solution implementation, the human element requires sustained, heavy investment. The source documentation reveals a common, critical error in ERP deployments. Users receive brief, preliminary training and are then left isolated for months before utilizing the system. This approach guarantees systemic failure. Executives must resist the urge to cut training budgets when project timelines begin to slip. End users require deep, ongoing instruction and must be integrated into the system testing phases. Without continuous training, the workforce cannot execute the new business processes, rendering the massive software investment functionally useless and actively harmful to the corporate ledger.
Chronological Recovery and Action Plan. Section 5 outlines the chronological recovery and action plan. Establishing a halt was mandatory to stop the bleeding. Shaping timelines around reality recovery required the immediate suspension of the rollout. A flawed deployment cannot be fixed while it is actively spreading through the corporate structure. By the summer of 2000, the operational degradation was too severe to ignore. Leadership was forced to make the incredibly difficult, highly expensive decision to stop all forward momentum. In June 2000, the brakes were applied. It took nearly a full year, until April 2001, just to finalize a new, coherent blueprint. The final rollouts were not completed until the first quarter of 2003. This chronological sequence provides a crucial executive lesson. Forcing a project timeline to conform to a predetermined calendar date results in shoddy execution and fatal structural oversights. True recovery required management to completely discard the initial schedule, define the absolute business requirements for success, and then mathematically construct a new timeline that accommodated those specific goals.
The sequential protocol for recovery, this strict sequential protocol rebuilt the initiative from the foundation up. It forced an absolute alignment between the functional divisions and the IT department. The executive interventions were decisive and uncompromising. Execution halt. Step 1. The rollout was frozen to stop the operational bleeding. Leadership reassignment. Step 2. Accountability was enforced. The lead project manager was removed and reassigned back to Switzerland. Stakeholder realignment. Step 3. 19 key stakeholders were pulled from the daily operational grind and convened for an intensive 3-day off-site retreat to renegotiate the architecture. Bridging the gap. Step 4. They created a new structural role. A director of process change was hired specifically to serve as the critical liaison, bridging the gap between the isolated project team and the disparate functional divisions. This protocol ensured that technical development would never again outpace operational readiness.
Phase A Core Stability Guardrails. Section 6 establishes Phase A Core Stability Guardrails. Protecting the baseline core integrity ensures long-term operational survival.
The danger of over-customization. The recovery of Project Best was not an accident. It was the result of strictly enforced operational parameters. As we conclude this explainer, we must outline the non-negotiable mandates that safeguard an enterprise system post-deployment. Enterprise software is deliberately built to be generic so vendors can scale their product across multiple industries. This presents a binary executive choice. Organizations must either pay to heavily customize the software to match their legacy workflows, or they must fundamentally alter their workflows to match the out-of-the-box software. The source explicitly warns against excessive modification. As customization requests increase, budgets inflate, timelines extend, and the probability of systemic bugs rises exponentially. Executives must perform a rigorous balancing act. Not every process deserves to be re-engineered. Attempting to force a highly customized legacy process onto standard software often breeds massive instability and shatters core baseline integrity.
The culture of continuous improvement. These non-negotiable mandates established a culture of continuous improvement heavily documented in the successful recovery. Top-level executive sponsorship is only half the battle. Universal buy-in requires active consent from the operators on the floor whose identity capital is on the line. The strategy moving forward was precise. Secure that universal buy-in before writing a single line of code. Demand and heavily fund continuous, in-depth end-user training. Ruthlessly dictate that timelines conform to business requirements, never the reverse. Critically audit every process before re-engineering it to avoid unnecessary disruption. Finally, institutionalize the change. Similar to Nestle ERP hiring a process development manager post-rollout, organizations must appoint dedicated liaisons. Their sole function is to bridge the business units and IT, ensuring the enterprise remains focused on optimization rather than merely maintaining baseline systems.
The financial return of systemic unity. By securing this foundation, Nestle USA realized over $325 million in savings by 2002. This was largely achieved through unified supply chain forecasting. Despite the severe early failures, the implementation ultimately paid for itself by neutralizing internal departmental friction. Under the legacy system, a sales representative would provide a forecast, the demand planner would distrust and alter that number, and the factory would reject the planner's number entirely. By forcing everyone onto a common database with standardized processes, Nestle eliminated this subjective guesswork. The data became trustworthy, the organization could suddenly forecast demand with extreme precision down to the individual distribution center level. Phase 8 stability was achieved, and the financial returns followed.
The final executive assessment. Before deploying a single line of code, executives must confront the human element and realistically evaluate their true operational baseline. The Nestle case study proves that enterprise architectures possess immense power to streamline global operations and generate hundreds of millions in retained capital. However, it also proves that technology cannot cure a fractured organizational culture. If you attempt to automate broken, decentralized workflows without consulting the personnel required to execute them, you will guarantee a highly expensive operational failure. Review your own transformation initiatives today. Are you just funding a massive disruptive software installation, or are you meticulously executing a strategic transformation that protects your operational integrity? The answer will define the financial survival of your architecture.